Hello everyone, and welcome to the PivotBoss Monthly Market Outlook for June 2022. Today is Thursday, June 2nd, 2022, and we are on our last month of Q2 of the first half of the year, basically. Decent rallies here today, and we have a lot to get to, but first, welcome. Thank you for joining me here today. My name is Frank Ochoa. I am also known as PivotBoss. I wrote a book called Secrets of a PivotBoss a while back that continues to get great praise from around the world. And we still use a lot of those concepts from that book in our analysis and trading day after day. Today, as it is a new month, we will be using a lot of the concepts that are in that book. Higher value relationships, for example. Lower value with a change of bias, various rejection signatures and things of that nature. And again, it continues to be a great book. For those of you that haven't checked it out, please do at pivotboss.com and at Amazon and anywhere you can buy books. Here, I wanted to start off with just a quick overview of the market. We're going to talk about the futures markets, various indexes like the ES, the NQ, YM. We'll also talk other commodities like crude oil, for example, gold. We're also going to look at various stocks, some of the big stocks, Amazons, the Apples, and Googles of the world. And we're also going to look at various stocks that you can engage from a swing basis, from a 1 to 5 day basis, or perhaps the rest of the month. And if you have any ideas on what you'd like me to look at or have any suggestions, I'll also take those requests as well and get to those when we can. So just type those in the chat box here. I'll be monitoring the Zoom chat box and also the chat box in our normal trading room. So I'll be able to respond to any questions or recommendations you have in those various spots. Also, this is being recorded, so if you want to rewatch this later on, or if you're not here live right now, you will have access to the recording as early as this evening. So we will be back at it here for the monthly market outlook for June 2022 here. Very excited about getting started here. And again, thank you for joining me here today. So let's take a look at a broader look at the market for a moment. You can see today, surprising rally, teetering on short-term support here, 40.70 for the ES. These are 60-minute time frames. You get the 12.450 level in the NQ, the 32.500 level here for the YM, and we saw an early attempt at support in each of these indexes here, and a very strong hold. Not only a strong hold of those levels, but a very aggressive reaction to the upside, and a big time rally that took us back to the previous session's highs. For the YM, it went bullish outside day. The NQ also bullish outside day. Again, that's a rejection from chapter 2 of the book, outside days. These also began with extreme reversals, another rejection technique that we look for from chapter 2 of the book as well. That extreme reversal right there is one of my favorites. You can see it here as well. Anytime you get that extreme sell-off and then you follow up with a counter bar, there tends to be 1 to 5 hours of strength that can follow. It's one of my favorite rejections that you find in the intraday time frames, in this case the hourly bar chart. So not bad at all. Very good reactions. The one thing here that maybe uses a caveat is that we're still basically within the range for the week, a very narrow range for the NQ, and same thing for the YM, the ES, etc. So good day, but at the same time, given the overall weakness that we've seen in this market, there still needs to be kind of a prove it quality here, a prove it type of mentality for this market to actually prove that it can go higher. And not only go higher, but stay higher. There are quite a bit of bear market rallies that can rip your face off and be very, very strong, but at the same time, you see a significant rejection and a turnaround the other direction. So that's still the case here. It's still persistent, but to be able to identify at least some of these short-term turning points can be very beneficial. So Looking at these higher time frame markets, we're going to bring up right now let's start with the YM for a moment, which is the Dow. So bringing up the chart over here, and this is a higher time frame chart. There we go. Again, one of the things that's very impressive about the recent move is this is the biggest rally we've seen since that mid-March rally right before we hit new lows for the year. So if you look back to this failed new low right here, this was also a bullish outside day. The way I define a bullish outside day is when you have the low, which is below the previous low, and then price closes above the previous high. That's how I define a bullish outside day, in addition to a range requirement as well. The range of the day needs to be a certain amount bigger than average, or at least greater than average, and that would give us a significant rejection and would suggest a 1 to 5 day rally up ahead. That 1 to 5 day rally played out very nicely. You can see from that rejection day we rallied up to these highs, and then it became sideways for a number of days, about a week, and then it finished with a strong move right in here. And when we came back on in April, we mentioned this is a really good rally, a very solid rally. If we were to pull back and find some strength, we could actually make a bit of a move higher and may even go break even on the year. But I also mentioned if this is a strong top in a bear market rally, then if we give up the previous month's midpoint, things could take us right back to new lows on the year. For the YM, it actually took a little bit longer for that to happen. If you look at the NQ, for example, that high, which we will in a moment here, that high led to a quick break of that midpoint and a very significant decline. Whereas this one took a little while longer to build out. You got the higher high failure here, and then things, the wheels fell off a bit. When you look at this reaction, very similar to what we saw back here as well, and it's kind of similar to what we're seeing right now. We're seeing a pretty solid rally off of the lows, but still we remain in a higher time frame downtrend. The overall headline risk remains quite negative. We still have geopolitical events, still have economic events here, all the various things, a hawkish Fed, rising inflation, rising gas prices, rising prices in the, for food, all kinds of various things that can suggest more weakness up ahead. So that's why I mentioned we're still kind of in a prove it state. While this is a strong rally, it's very difficult to suggest that this is a low, that this is the low. We probably haven't seen the low yet for the year. So while this is good and is strong, keep in mind some of the strongest rallies that we'll see occur during a bear market cycle. You tend to see very, very powerful rallies in a bear market cycle. Whereas when you're in a very bullish trending phase, you don't see that strong of moves. It's usually, business as usual. It's just kind of chugging along, little pullback, chugging along. Whereas this is kind of a much stronger 5 or 7 day move than what we've seen here before. So we still may not be done as a whole. Now, in terms of where might we be headed, we still have this blue line to go reach up ahead. That's 29,550. That's the previous year's low price. That would give us a bearish outside year to the downside. You can see right here in the first couple trading days of the year, price took out the previous year's high. Price then took out the previous year's close and dropped precisely to the previous year's midpoint. And this was the level early on this year that we discussed that we need to be able to hold that level, because if there's a failure there, we could be rotating right to the previous year's low price. And that again is still in play. That's still in play right now. We got very close here, didn't quite get there on this leg, but that could still be the case. Right now we're still trading around the previous year's midpoint. And these yearly pivots, these are what I call the PivotBoss pivots. So for those of you that have the book, you know I discuss two forms of pivots, the floor pivots and Camarilla pivots. This is what I call the PivotBoss pivots, which are based off of the actual previous high, low, close, and midpoint of a prior range, and then you use the extensions of that range, 25, 50, 75, 100, to make it very clean and easy. And oftentimes what I found is that the previous high, low, close, and midpoints are the most important levels on the charts. And again, whenever you saw that tested here, it was a very extreme rejection with a huge bounce. You can see how price traded off that level here, how it gave it up here, and now we're back at it yet again. So that midpoint, very, very important at the moment. So we still may have more downside ahead toward the previous year's low. This bounce, while it could see a little bit more strength ahead, it could easily see a failure that ultimately leads us down to that low at some point. For now, I would say the 32.5 level is very, very important as a short-term level. Today it bounced off that zone, and the idea is that we could be looking at a bounce up toward 34K on the high end. 34K is the top of this recent market structure right here. Very reliable. You can see when it came back above it, it's held it. We're trading around the FOMC key level from May. Again, that could be a short-term target. That's also the previous month's high price. And it's also yearly VWAP. So if you calculate yearly VWAP beginning from the beginning of the year and you calculate it outward, you get this level right here, and it's basically 34K. So you have some confluence there. Previous month's high, yearly value, and the top end of this recent market structure. So if this price can hold 32,500 here, which it did over the last couple of days, we could be looking at strength ahead. Now, today was a very good day. We do have NFP report tomorrow. Non-farm payrolls comes out tomorrow morning. That could provide a catalyst, good or bad, one way or another. And this bullish relationship could fail right away, depending on how the numbers come out. But as of right now, we see another thing I want to discuss here, and then we'll go a little bit quicker on some of these other charts. You see, this is the pivot range right here. This line, and this line for last month. And the pivot range for this month is here, here, and here. So it's a lower value relationship. However, price closed above this month's pivot range last month. So that's what I would call a lower value with a change of bias. That's usually an indication of a change of bias where that lower value relationship is being rejected, and you likely see a move higher, at least in the near term. And so what we're seeing right now is exactly what you would expect to see, which is you close higher above the pivot range for the new month, and the first drop into the pivot range would be defended by responsive bulls, and from there you see a continuation higher in the short term, likely to the previous month's high, which is that line right there. Previous month's high also coincides with, again, that market structure level and an FOMC key level from before. It's basically 34,000. So 34,000 could be ahead from a short-term perspective. Very short-term. But as you know, in a downtrending market, whenever you hit value from below, it tends to be an opportunity for bears to defend, and then you see another rotation down. So again, trying to temper expectations on how far we might go or how long this rally might last is still very much in a prove-it state. From a short-term perspective, and we'll talk more about some of these stocks to look at as well and what to look for over the next day or the next week, for example, to 2 weeks, this was a strong outside day. A rejection of the previous session's low and a close above the previous high, and the range for the day was rather high. We can use this indicator down here, the PivotBoss Advanced ADR indicator, and what you'll see right here is that today's range against the average was fairly good. It was higher than average, a little bit higher than average, not significantly higher than average because we've had very volatile days over the last month, but good enough. And that's what you're looking for, at least something greater than average. And that's it. So tomorrow, for those of you looking to engage the Dow or perhaps trade options on the DIA or trade the DIA outright, however you want to engage it, an early pullback tomorrow morning could provide a checkmark trend day up where price pulls back and then a morning low could be defined, and from that morning low we could see strength heading into the afternoon. Again, the NFP report is going to be very important, because if we come out with the NFP report and all of a sudden we're gapping down big or something like that, that could be a major crushing move, just very crushing to the downside. But shy of that, again, if we pull back and say we get a retest here of 33K and the previous month's close, and we start to find an early morning low, that could provide a very nice checkmark trend day up, and we could be looking at 34.4, 34.5, or perhaps higher. And over the next 1 to 5 days, we may see a march toward that 34K level. That's your one-day idea tomorrow morning, plus your 1 week, out to next Friday idea. Can we get to 34K? Once you see 34K, there could be a major rejection here that brings us right back to where we came from. Again, you're retesting value, composite VWAP from below, in a downtrending market, in a bearish market, and just to snap back to that level is very solid. So again, the idea for tomorrow, morning weakness could provide an opportunity to buy the dip for afternoon or late day strength, and if that plays out in that way, we could be looking at a 1 to 5 day continuation toward 34K. So there could be a plus 1,000 points, 33,000 to 34,000 up ahead. I would say tomorrow, though, if NFP comes out and the market doesn't receive it well, and we end up closing against this previous midpoint, things could get ugly very, very quickly. And again, ultimately, we still may need to see the previous year's low up ahead in the YM. So let's take a look now at the ES. Here's the ES, very similar to the YM. Keep in mind, on up moves, the YM has been outpacing the NQ and the Russell 2000. The ES has also outpaced those as well. So on up moves, we've seen much more strength out of the YM. Same thing with the ES. Here, again, we've already detailed a lot with the YM. This is very similar. This is the pivot range last month. This is the pivot range this month, and price closed above it. So the first drop into that range is typically defended for a push to this level right there. The NFP report comes out exactly 1 hour before the RTH open, 7:30 a.m. Central. 7:30 a.m. Central, so 1 hour before the RTH open. So this high right here could be in play, 4,300. 4,300 is the top end of this market structure. One of the things about the ES has been doing really well with market structure. 4,100 has been in play. You can see hit, hold, then it broke, made it resistance. This lower low failure brought us back to 4,100, and now it's trying to hold that level. So if this is holding this level, this could be a transitional phase that takes us to the top end of the next market structure. Very similar to the YM. The next market structure is 4,300. So tomorrow, for the ES, very similar to the YM here, we're looking for an early pullback, morning pullback, that could provide a buying opportunity for later day strength. If that plays out, we could be looking again at a 1 week move that takes us up to the previous month's high. That's 4,300. You also have a declining composite VWAP there that takes you to 43.32. So somewhere between 4,300 and 43.30 could be in play over the next week. But once that happens, it wouldn't surprise me if we see rejection and perhaps we drop right back down. So again, trying to temper expectations. I'm not trying to call this a low or a bottom. We've seen many strong lows this year, and each of them so far has been an opportunity for bears to defend or sell ahead of new lows. So even if we were to rally into this zone, it could still be an opportunity to drop this thing to the previous year's low. The previous year's low for the ES, 36.52 half. Again, very similar to the YM at that 29.552. That could still be in play. So again, here's the previous year's midpoint right there. You reject the high and close. If I show that real quickly. And this is what we mentioned, you know, the last week of the year. We said, hey, if we take out this high, that could offer a rejection that takes us right back to this midpoint. It happened in 1 month. And that's where we mentioned this could be a buy, and then you double topped and came back, and then finally it gave it up big time here, and we've dropped and got this close, that close to getting the previous year's low, and then we're bouncing now. Usually we don't see prices get that close to a key level and not get there. So we still may get there at some point. So again, even if we were to rally and continue higher toward 43, we may still see this zone become a trap, and we still may see this level tested somewhere down the road. You know, where this is all confirmed is the current month's midpoint, the midpoint of the pivot range right here, 40.50. You know, you give that up, and it opens up the downside. For right now, it's holding it, and so we may be headed higher, and then it can slingshot back to this point at some point down the road. But for tomorrow, early pullback could be a checkmark trend day up. From there, we may see a continuation toward 4,300 over the next week of trading. Now, let's take a look at the NQ. The NQ is one that did hit the previous year's low. Obviously, this one was much more bearish. Tech sold off in a tremendous fashion compared to blue chips, for example. Here's the previous year's low right there, that blue line. Lower low failure. Got a surprising rally above this 5-day range, and here it steps back above the 12,207s. And so far we've rallied yet again to new highs. Today was a bullish outside day. Not bad. Not bad. It looks like it's trying to make a move. And again, look at how strong these bear market rallies can be before they pull the rug out. You know, even this one was very strong. This was a quick move up. We're seeing a similar move now, but we may not be done with it. We may only kind of have begun it. So if you look at this one, from this perspective, you'll see the 12.6 level right there, 12.6. You know, it was support. The upper end of that level is 13.6. So you have 1,000 points of range here. Then you go 12.6 down to 11.6 right here, and you have 1,000 points of range here. And then you go 13.6 up to 14.6, and that was basically your upper end here as well. So this thing's working in 1,000 point increments. And after seeing a failed new low at the lower increment, we've seen a rally back above the 12.6 level. So 12.6, the fact that we've pushed through it so hard today and have continued to trade above it all week and all month being 2 days, suggests that we may actually make a move again to the top end of this range, the top end of this market structure here, that 1,000 points. That takes us to this black line, which is basically the previous month's high, and that's 13,600. So that's a really, really good target up ahead. And likely, again, if we hit that target, it wouldn't surprise me if we drop back down and maybe trade in here a bit in the best case scenario, you know. So again, there could be about a plus 1,000 to the upside in this one. Great market structure, 12.6 to 13.6, 12.6 down to 11.6. Seen some trading in here, we've seen some trading in there, we've seen some in here. it looks like we're now trying to recover that prior market structure low, which would take us back to the high. In many cases, that would come back down and you trade in here for a bit. So again, from tech perspective here, an early pullback tomorrow morning could provide an opportunity to bounce this thing back up, and we could be looking at a continuation not only back to the FOMC key level above from May, which this is probably one of the few that hasn't hit that level yet. The others have already responded and reached it. This one could be ahead, and then you could see a follow through up toward 13.6. So that could easily be in play. Again, even if we do see that move, and from the 11.6 level to 13.6, that'd be about a plus 2,000, right? That's a huge move, especially percentage-wise. But at the same time, it may not mean that we're done. You know, we could easily see a drop back down, easily see new lows ahead. Yeah, thank you very much. I see those of you posting various charts to look at later on, and we will definitely get to those. So right now, lower low failure, the ability to reclaim the previous year's low, the ability right now to reclaim the 12,600 level. That is multiple good things right now for this move. Keep in mind we dropped from 15,250 all the way to 11,500, nearly 4,000 points. So to bounce back up to this point doesn't seem like too far-fetched of an idea. So again, all of this could be moot if something bad happens with regards to the NFP report tomorrow and the market takes it negatively. Again, if we're opening, keep an eye on the ETF counterparts to these futures. Right? Futures are trading all night. They could be trading right up here, and then NFP report comes out, and then by the time the RTH opens, we're somewhere here, which would mean that the actual ETF would gap down below the previous session's midpoint. If the ETFs gap down below the previous session's midpoints tomorrow morning, things could get very, very bearish very fast. Very fast. It's basically like one of these days here where you're sitting here and the next day you're gapping down. Obviously, that would just take the floor out. And if you're going to take out the 450 level, we're retesting lows very quickly. But right now, with the way this looks, there is very good short-term bullishness that can take us up to the next area of resistance, 13.5 to 13.6 here in the NQ. So those are a few of those markets there that look pretty strong. Let's move to another market that looks extremely strong, crude oil. Crude oil had a huge day today, up 163% of ADR, a range of 6.5 points, and it's been averaging 4 points per day. You look down here, again, this indicator down here quantifies current price range and quantifies the average range as well. So this is a huge day, $6.57 a range. The average 10-day range is this gray line. The average 5-day range is this yellow line. Notice where this yellow line was a few days ago, and notice where it is now. It has quickly come up to overtake the 10 period. That tells us that the 5-day average and current volatility is increasing right now for crude oil. The volatility is increasing. Additionally, to have a strong rejection day like this and be such a big high range day gives us directional conviction. Today is basically like this day back here. A strong decline, a strong rejection, a bullish finish. This was a huge decline. It gave up the 115s and dropped to 111. 111.20 was the low. And as I mentioned in the trading room today, I know some of you have already heard this story, but in the trading room here today, we saw this thing rally off the 111s back to 114.5 in about 15 minutes. So it rallied over 3 points in 15 minutes and then it took the rest of the day to rally and close the day 117.55. Again, over 6.5 points off the low. That is huge. That is a very, very strong rejection. The reaction was strong. The lower low failure was strong. It happened at the previous week's midpoint. So many bullish factors there. The other thing we mentioned yesterday, actually this was on Tuesday, with this strong rejection we mentioned, if this thing pulls back into 116.5 to 117, that could be a selling opportunity to 112. But once it gets to 112, we want to watch for signs of rejection. There's a couple of reasons why. Number one, here's the pivot range for last month. Here's the pivot range for this month. So it's higher. When you have a higher value relationship, the first drop into the pivot range tends to be defended, and then that's your buy the dip. Secondly, you have your rising PIMA trigger zone. This yellow line here is the 8-period average, the 8-period pivot-based EMA, and this top gray line is the 21. That is your bullish PIMA trigger zone. So in a very strong trending market, when this thing is sloping up, when prices come into that zone, it tends to be an opportunity to buy. When you get a strong rejection, it can be the best buy. And that's what we're seeing right now. The other thing you're seeing is this rounded edge over here. That rounded edge can tend to be very indicative of a coming breakout, a major breakout to come. And when you look at the 115 level here, you'll notice 115 was major resistance for a long while. And over the last 2 days, price has found acceptance above 115s. And the one time it dropped below it, today, it saw significant rejections of prices below 115s, specifically below 114. So most of the action the last 3 days has found acceptance above what had been major resistance. What that says here is that we may be looking at another move that takes us higher. Higher back toward 125, higher back toward 130 over the next 1 to 2 weeks. So rounded edge on this right side, that's not great drawings. Rounded edge on this right side, higher value relationship, strong rejection in the bullish PIMA trigger zone, and acceptance above 115s. All of that suggests a continuation up into this space, which hasn't been traded but for 2.5 days back when the initial invasion of Ukraine occurred. So that is significant right there in and of itself, all of those factors. So if you're looking for something, I hesitate to say surefire, but if you're looking for something that is much more bullish and has a higher probability of going higher than anything we look at over, this webinar here, crude oil is probably that thing. So for tomorrow, again, very similar to the outline that we're looking at for the ES or the YM or the NQ, early weakness tomorrow ideally would be defended by responsive bulls for a push higher. If it closes higher, closes above the 118s, we likely see a continuation up over the next week. That can take us to this target right there. That's the 125.55. And this is the 5-month average. So instead of using a 10-period average, I usually use a 10-month average. You'll notice that the volatility for this year has been much more significant. January, February, March, April, May. So I took those 5 months and gave us an average, and that from this strong low this morning, from that low you forecast higher average monthly range over the last 5 months, you're going to get 130.34. And the 125.55 is the 75% of that. So that's what I call, this is the 100% up here, and this is what I call the high probability target zone right there. So there is high odds that we can get to that target zone over the next 2 weeks. Over the next 1 week, we could easily make a move toward 125. We may actually be between 119 and 120 tomorrow in the most bullish scenario. So tomorrow we could be somewhere in the 120, 119 zone. So any morning pullback tomorrow, if we can find a strong low tomorrow morning, You can then use that low and forecast higher about 4 points. Right now it's averaging 4 points on a 10-day basis, 4.5 points on a 5-day basis. So $4 to $4.50 is about the range that we could see tomorrow. What if we pull back to 116? 116 is the low, and you add 4 points, you get to 120. That's very simple. What if it goes down to about 115.50 and you add 450, you get to 120. So somewhere in that zone could be in play tomorrow. The one caveat I would say to that is that after a big day like this, there at times may be a tendency to see a more digestive day the next day. And in the trading room today, I likened it to this 2-day range here. You had that strong day, and the next day was an early pullback. You did rally, but it wasn't a huge continuation day. It was just a bullish, day, right? It was a nice bullish day. If you look over here, same deal. Big rejection day. The next day pulled back. You found a morning low, and it rallied, but it wasn't, rip your face off rally. Over here, same thing. So maybe tomorrow's 3.5 points of range instead of 4.5. Right? If you get 116s on the morning pullback, maybe 119 half might be the upper end of the range. So again, if tomorrow can be bullish, if the morning low is defended, we may see not only a bullish day tomorrow, but we may see a continuation over the next 1 to 2 weeks that takes us higher toward the 125.55 target. So this could be significant tomorrow. Very, very significant. And it could be very meaningful to trading range action or movement within this range up here. Again, the 115, 116 zone. Nothing really traded in this zone here. And it looks like it's about to make that move to the upside. So we could be looking at a nice continuation higher in crude oil over the next several days. So buy the morning dips could be in play unless the NFP report comes out and wets the bed in some way, right? If it comes out and just fails badly and the ETFs for these markets are gapping down in some significant way, that's the one thing that could crush this. But overall, right now, it could actually be a catalyst. It could be a surprising catalyst. We just have to see how it plays out. So right now, again, morning weakness could be bought for late day strength. If that scenario plays out, we could easily be looking at a continuation toward 125s. Not bad at all. All right, let's take a look at some stocks right now. Actually, you know what? I forgot to talk Bitcoin and Ethereum. Let's look at these real quickly here. Man, oh man, crushing moves here lately. May was about as bad as it gets. It gave up major market structure, and it did so with a ferocity that we hadn't seen in a long while. Some of those altcoins really got destroyed. And it goes back to the point I mentioned all year long, really. If you're going to dabble in some of the altcoins, put an amount that you don't mind losing all of, right? For example, that Terra Luna went and lost 100% of its value in literally a week. Went from $86 to zero, or about as close to zero as you can get. I think it was 0.000036. It was like 4 zeros and then a couple of numbers. That's crushing. And I know some of our traders posted in our room, from Reddit forums where somebody lost 74 million in a week in that one altcoin. As you never believe something will go from $86 to zero in 1 week, but there it is. So some of those altcoins, again, we knew from the very beginning that if you're going to dabble in those, put an amount that you don't mind losing all of. And but for the bigger coins like Bitcoin and Ether futures, again, even those you had to be very careful in. And this still has been a crushing move and has been very painful to watch in many cases. This has been a crushing move. You know, from the initial that this looked like we were about to see a rounded bottom, transition phase up. We were seeing the initial pullback and hold. And I said, if this is a trap, watch this midpoint, because that midpoint there would open up a move back toward lows, and it could even open up a move back to the previous year's low. And it did that and then some. And it actually got into the 25K zone. The 25K zone is a level that we talked about last year. Back when price was sitting here at 28, you know, right in here, I said, okay, this is it. We're about to see that big move down. We're about to see a test at 25. And if it can't hold 25, then it's going to 15. The reason I mentioned 15 is because it's that major LVN here. It's the breakout point before it doubled to 30. And it's all of this narrow LVN channel. Look how narrow that channel is. And with a lot of those high-flying tech stocks we mentioned before, at some point down the road, the reckoning usually comes. It usually has to go trade through that narrow range and fill in that part of the profile. And we are so close to doing that right now. We are so close to seeing that happen at the moment. And, you know, we have this narrow range that is developed right here on top of the 28K level. And again, this is the last line of support. That's it. You had your one big dip day right here, and you saw it bounce. But the bounce has not been resounding. It has been very lackluster. It was a one-day wonder, really, and that's it. You look at the 32,500 level right here, big time level that if it got above it, you could see a move back toward 37.5, 38K, and you kind of mess around in here for a little while. But again, what the circumstances that led to this rally and this rally are no longer present. You know, the cheap money, an accommodative Fed, all these various things just aren't there right now. Instead, it's quite the opposite. High gas prices and higher, you know, inflation and an unaccommodative Fed. That leads to less discretionary income and spending and the ability to hold on to these coins or add to these coins or be in any of these coins. And so again, those pressures right there could lead to finally seeing a big push to the downside. Now, to quantify this, again, we use our ADR indicator down here. And let's just go with 10 days for a moment. I could go more. Let's bring it up for here. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. So let's go 14 days just for the heck of it. Boom, 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 boom. There's 14 days. And down here, what you'll notice is when you have a narrow compression, down here it will note it as this fuchsia or magenta color right there. That means that it's less than 65% of average range. If you look over here, the the range is actually 38% of average. 38% of average. The range is 4460, and usually the range would be about 10,500. I mean, that's how wild things have gone. The last time we saw something that compressed was here, and that was right there, right? That compression. And look what happened there. You had one big day up, then you had one big day down that followed here, and then the bottom came out. And you saw this huge move, and you went and got all of this range. That's what we're looking at now. We're looking at eventually seeing a breakout from this narrow compression, which is clearly denoted here. And at the very least, we're looking at 10,500 points of movement, if not something along the lines of 13,000. You need to hit 13,000 at some point over the next 2 to 3 weeks in order to turn blue. So when you go from compression, you go blue. This is almost compression, you go blue. You go compression, you go blue. That's compression leads to expansion. Another concept from my book, right? That's an old school technical analysis thing. But we're just quantifying it here with a very simple indicator. So now, if we're going to move at least 10,000 points, then you need to see a breakout from this range. The breakout is either at 32,000 or it's at 28,000. So if you break through 28,000 and drop 10,000 points, I mean, it takes you off this chart. It takes you to 18K, right? 18K. So there's 18K right there. And that would be, again, from the edge, that's 10,000 points. If you go to about 13,000 points of range, that takes you to 15,000, which is that initial target I had from last year if we were to have broken down. That can happen. So, again, when you look at these charts, anything, you have to tell yourself anything can happen at any time. And when you know that anything can happen, you will appropriately leverage yourself and mind your risk in a way that protects yourself. As we said, Terra went from 86 bucks to zero in literally 1 week. We've seen crude oil go to negative 40 before, right? That was during the height of the pandemic when everything shut down a couple of years back. Basically at this time, I think it went negative 40 right around this time. I think it was the June contract of 2020, something along those lines. So anything can happen. So this doesn't have to hold 28K. And as a matter of fact, you know, we're using math here to tell us, okay, this has enough energy, it has enough gas in the tank to take us at least 10,000 points, if not more, 13,000 points. So if it breaks 28K, we can easily go between 15 and 18K up ahead. Now, what if it's a bullish rejection? What if we break to the upside? You know, if we break 32 and rally, you can add 10K and maybe we're back to where we were, 42K. Again, what's going to be the catalyst to get that going? I think right now, especially with everybody knowing Michael Saylor's position, everybody knowing where MicroStrategy right is at, it seems like there's a lot of folks gunning for those, for that capitulation of that company and his position, and that's around 21K. As of one report. Again, that number can tend to fluctuate, especially if they adding higher, then that number can go up higher. So the only way for that number to drop is to buy it cheaper. And if they've been defending here, defending, then that number creeps up. So it might be even 23K or something now. Who knows? But if you take that number out, bad things happen, and it happens very quickly. Look at that 5-day range, went from 40K to 25K. It was 5 days and $15,000 or 15,000 points. That's huge. So it doesn't have to take long. That's one thing. So this is significant. And again, we've seen Bitcoin bounce off this level before. How many times will it bounce before it finally fails? And as we know, you know, these thin portions of the profile that weren't traded very well at times need to go get filled in. And if it's going to go fill it in, then why not go grab value down below? Value is 9,300, which would cut this thing by another 66% plus. You know, that's significant. So again, we're building some significant energy here, and we could certainly be looking at a massive move to come sooner than later. So that's just a quick quantification of Bitcoin. I guess it wasn't that quick, but Ether futures here. Let's take a look at that one real quickly here. This one's sitting on 1700. 1700 is another major level that we talked about before, over the last year and a half. That's where the initial rally occurred here. Then it came from 4,600 all the way back to 17. Then double bottom and rallied all the way to 4,900, and now has come all the way back down. So again, that's a lesson in taking profits when you can. I mean, to see something go from 1,700 to 44 and then all the way back, and you're like, man, that can't happen again, can it? And then it does even one better, 4,900 and all the way back. That's huge. Take profits when you can. At the same time here, we may not be done. We have a similar compression that's developed, and you can see it down here. And this one's forecasting a move of somewhere north of 1,000 points. So if you cut 1,000 points from where we currently are, 1,800, that takes you to 800 on the chart. Now, one thing I want everyone to see here is this key range right here. That's the impulsive sell-off that happened, and then it bounced back to the midpoint, and it gave us this great key range. The trap up here was tremendous, and it turned down, and now it's holding below that edge. The 100% target is right here, and it's 902.50. That's the 100% target of this key range. That's why I love these key ranges. When you get a significant key range of that magnitude, it's telling you where the playing field is, it's telling you where the extensions are. Initially I said, if we get into this zone here, the 1844 level could be the best buy on the chart, and we could be looking ultimately at a rally back toward 46.69. That's the 150%. And we're there now. You know, that's still in play. It's still trying. You got a box that's formed below the key range low. If it can pop back above 2200, man, oh man, maybe it has a move back toward 3650, and maybe over time you reclaim those levels. Again, as of right now, who knows? Who knows what's going to get this market to go up? It seems unlikely. And instead, we may need to see this thing further flush and grab the 100% target. Again, that's 902.50. So we've quantified it here. It looks like at least 1,000 points, maybe north of 1,200 points of range coming. So if you break 1,700 and lose 1,000, that takes you to 700 points. Now let's go to the cash chart. This is the cash chart of ETH versus the US dollar. The cash chart actually shows us a little bit more data than the futures, because the futures came on like I think April of this year, so we're only seeing like from here. But if you see at the beginning of that year, it began the year at 717.76. That's basically the low of the year, and then it rallied from there and went boom, and everyone felt great. So if you were in early here, that pullback to 1700 wasn't so bad. I mean, it was bad, but not so bad. And then you went to this high, and then now you're coming back down. So 1700 here could still open the door to 717. If you break 1700 and we have, say, 1,000 points of movement to go, that's 700. So that's the previous year's low. And right now, this market wants nothing to do with the previous year's high. It took the previous year's close offered straight away and never came back to it. And here's the previous year's midpoint, 2791, basically 2800, and it's fallen straight away from it. Kind of like the ES, kind of like the YM. If you're going to give up this level, you more than likely go grab that previous low. Again, not trying to be the bearer of bad news here, but at the same time, as I mentioned, anything can happen in these markets. It doesn't necessarily have to go up. And if you're going to fail at 1700 and you have this much energy built up in this chart here, it's telling us that we have, 1,000 points where we could easily go and make that move and retrade back through this ill-traded zone of the chart. So that would be significant. Again, 1700. That's why I've mentioned in the pre-market videos, we are at critical support here for both Bitcoin and ETH, and we have enough energy built up there that When the time comes, if it breaks, it'll break hard and fast. If this thing can climb back above this key range low, back above 2200, then 2200 to 2800 could be in play, and you kind of sit in here for a while. Best case scenario. So some thoughts right there. Good question here regarding inflation and oil and equities here. Could we have both equities and oil up? Wouldn't high inflation have negative effect to equities since they anticipate faster rate increase? That's a great question, and the response likely is that the markets may have already priced that in. We've all known for a long while that there could be multiple rate increases, 50-point rate increases or 50 basis point rate increases over the next at least 3 meetings. We've known this for a while, so the market may have already priced that in. And that's why the market also listens very closely to the meeting minutes and what Fed Chair Powell says, because it gives insight into what may happen beyond that. How will they approach beyond that? And that's where additional tweaks and adjustments can be made to the market. So maybe they've already been priced in to a certain or large extent. Crude oil, again, is reaching a season here where naturally crude oil is usually up, but now pressures and all kinds of other various things, geopolitical, is pushing it even higher, which could have a negative impact on stocks as well. And that's why we mentioned, again, there's still so many overhead pressures to the equities that even if we bounce, as we have, this could be a bear market bounce that just takes these things back down. But it's impressive how much the market can price in and how far out it can price things in. And that may be the case right now. All right, let's take a look at some other charts here. Let's see. Let's look at wheat. Is that the or is it ZW? There's ZW right there. This is one that, again, one of our traders in the room brought to us last year and again this year. But looking at the wheat chart in the weekly, look at this rounded bottom. It's one of the most massive rounded bottoms we had seen. It started to get above the rim of that pattern early last year and make its support and started to work its way up. And then this year it exploded to the upside, again in part to the invasion of Ukraine. And that is tremendous. And again, when something like that happens, it impacts everything we eat and things of that nature, from bread all the way to whatever else, right? That's huge. That's significant in many ways. And again, it just shows that when a huge rounded bottom like that is developing, it tends to have the most powerful expansion phase of any major pattern on record. And that goes back to my days at Nirvana Systems, when we had a huge database looking at as much data as we can look at on any chart available, and we would quantify all the data for various patterns of multiple time frames. And one thing I came away with was always the most powerful patterns were rounded bottoms, because they take longer to develop, thus the energy is more significant, and once the release of that energy comes about, the move is much more explosive. And that's what we're seeing here. If we look at this max available right now for wheat futures, as it pops it up here, it has by far surpassed anything we've seen in a long time, not seen since, drum roll, the 07-08 financial crisis. And you look here at 1363 half, the high so far this year, and bring it back, It just barely took out that high from back then. So that's something we saw earlier this year, that this market rallied very similar to what we saw before during that financial crisis. Look at '07. '07 was huge, and then '08 big time. But then ultimately it was able to back off. And that level is about 1,000, maybe 950, right? Look at how both of those rallies began. This one, rounded bottom, cup and handle, if you will. That rounded bottom pushes up, here it is, hold and explode. Over here, multiple year rounded bottom, pushes up, holds here and explode. Tremendous. And as I've noted here in our trading room as well, the '07, '08 top and the way it dropped throughout the year in '08 is very similar to what we're seeing right now. Almost right on the money. If you were to overlay the 2021 fall and 22 beginning over that '07, '08 similar time frame, it's very eerily similar. And you're seeing this be the same in terms of that, right? Ultimately, prices like this don't last forever, and the market structure is revealed down below. 600 is kind of that zone between 950 and 600, and you can see it here. So again, when you're looking at it purely from a charting perspective, obviously it's seen tremendous strength, overextended prices, and takes you right back to historical highs. And during similar catastrophic historical events, and perhaps the '07, '08 crisis was much more significant, as you know, we've seen how it played out, and we saw that this thing, you know, the market at least sold off the rest of the year. You didn't get reprieve until the spring of the following year. Can you imagine if we go another 9 months of selling pressure until we finally get a reprieve? I mean, we would that'd be tremendous, and it would be very, very exhausting. Having said that, this market structure here is very clear. The 1,000 level is going to be a level to watch here, maybe 950, but that zone right there is very important to watch. As soon as we give that up, there will be a likely return down the way, right? Whether it's 600 or 800 in the middle, you're going to see a move back toward about 800, and it maybe fills in here a little while and then makes a move back down. So we still have some very clear market structure here. Obviously, these pressures right now, this would be a chart to watch in terms of perhaps identifying when inflation may begin to back off somewhat, right? If price of wheat starts to drop below 1,000 or 950, that could be an indication that prices are dropping for bread and other similar goods and items, and that could be an indication of a decrease in inflation. So this could be a great chart to watch for that. 1,000 is going to be a very important level, and I wouldn't think it goes all the way to 600 very quickly. It's probably 800, and you basically bisect this larger range from here to here. So you know, you tend to see these massive moves that are significant. I mean, this was 2 weeks and we were up here. That's incredible. But you also don't see price stay up there in these areas for long, or for a major extended period of time. That fat part of the tail of the curve there tends to last for a while, but then ultimately you see it back off, and then here we are trading back here and then working our way back down, and we might be back to 600 by, again, next spring. Right? So this is an incredible chart, and again, props to JP for pointing this chart out to us last year, 18 months ago. The rounded behavior and how it could lead to an explosive move in prices, and it's panned out every bit of the way. Here's corn, and then we'll get to some stocks as well. Corn trading 728 right now. Another massive move. All right, we're on max available here. And very similar market structure. You know, down here, what is this, 318? Look at that support level. Up here you have about 450 as a market structure level. And then up here at the very top end of the range, there's 800. And again, 07, 08, during that financial crisis. Isn't that crazy how that happens, by the way? You know, you start to have a significant crumbling of the economy or various pressures that happen, and as such, the prices of food and goods go up, adding further pressures. And you see here the price of corn went, again, from $300 up to $750 very quickly in the first half of the year, basically. And we can get an exact top there. Yep, that's through June 9th. This is the week of June 9th. And right here, this is the first week of June. And then from there, it took the rest of the year to drop back to where it was before. And then we stayed in that normal zone here. And this is where it likes to trade. It likes to trade between 300 and 450. Over here, it traded between 300 and 450 for years. 1, 2, 3, 4, 5, 6, 7 years. And then the last 18 months went boom, up to 800 plus. And as I mentioned before, when you get these big events that happen, it's painful. It's painful at the pump. It's painful at the grocery store and things of that nature, but it doesn't last super long. It's not usually sustainable. And again, the idea would likely be for a fallback to say 600, maybe 550, this downward portion. And we're already seeing it back off now. And again, the last time it backed off was around June. If we look at these events over here, this was the end of May on that high, and over here it was August. So again, the market structure here would suggest that we've probably hit the limit on the upper end of this range, and we could be working our way downward towards 600. Maybe by the Thanksgiving holiday we have much better prices to work with here for the Thanksgiving food offering. So you know, again, this is tremendous, and it's incredible to see these types of events happen, but that is the market. And right now it is such that, you know, things got overinflated tremendously, but it still honors this market structure. And it looks like it's maybe has put in a top. That means any bounce could be selling opportunity, and we might be ultimately looking for a return back towards 600 by the end of the year. And then once it's able to give up 550, you'll drop back into where it's happily used to trading, somewhere between 300 and 450. But that might not be for a while. You know, it might be 2 years out or whatever the case is, by the end of next year, not this year. So right now, again, it looks like we may have topped out a bit, and we might be headed to the bottom of this higher market structure. Thanks for asking about those. Let's get to some stocks. One of the ones Mike asked about was CG. Oh, Lisa asked about Nvidia, so we'll look at that one as well. The Nifty 50 from Adit. This is Carlyle Group. Carlyle Group right now in a very aggressive downtrend. Again, alongside the broader market, very clear downtrend. Most things topping out in November. Still seeing new lows as of May. One thing that we've talked about in our trading room is the seasonal tendency of a stock market. the seasonal tendency, you always hear the old adage, sell in May and go away, right? And nobody really says when to buy it though, right? And usually you buy in November and sell in May. And if you take away everything in between that, you know, say June to October, you take away usually the worst performing months, and the best performing months are usually November to May. And this time around, that has been completely flipped on its head, unlike any other time we've seen in, again, 14 years. This was a sell in November and buy back in May, maybe, right? That has been the worst 6-month stretch that we've seen in a long time. I believe this has been the worst beginning to a stock market and a bond market on history, on record, right? Those are very, very bad things, right? We still may not be done. When you look at a chart like this, again, I love to look at the yearly pivots, previous year's high, previous year's close, previous year's midpoint, previous year's low. If you're going to reject the close, you're going to go to the mid. That's usually the best spot to then buy. But if you fail at the mid, you tend to make your move all the way back to the low. We're not quite there yet. It's 34 is the low of the recent month. Like I said, if we start this month with a little bit of strength, it may be an opportunity for bears to defend, and then you look for a push to this low. So the downtrend is still intact. Market structure is still intact as well. So for example, if you look at, say, this LVN right there, prior support, turn resistance. So again, if we rally into this zone and fail in the 40 to 42 zone, you know, at the very least you're dropping back to 34, and then maybe you see a market structure move down here, trade in here, and try to bounce back. So the downtrend remains in full effect. In this one, value is still quite a bit below. That would be crushing to see a move to value, because that would cut this stock in half yet again. It already went from 60 to 34, so that's not quite half, but almost. And now to go from 40 to 20 would be another half. I mean, that's big. I think right now this stock is still likely gunning for this previous low. Once it gets there, that might provide a reprieve here. With a lot of these stocks, it's just very difficult right now to see any lasting momentum to the upside, until the broader market can find the same type of strength. So right now, this one here is still in a very clear downtrend. You're seeing a lower value with a bullish change of bias, which means we may see some short-term strength ahead, and that short-term strength could be used as an opportunity to sell for another round of weakness. Now, if this thing can reclaim 42, so say it pushes through 42 and holds 42, then you may have a bit more upside into about 48 or so. Value here would be right at 44.40. So there could be some short-term upside, but again, trying to temper expectations on how far these things go right now. Let's see, another one here that was asked about was Nvidia. Let's take a look at Nvidia. I was looking at this one a little bit earlier and actually liked it. I did like it. I was trying to find, again, you know, this one hasn't quite gotten the low of the year. So as we mentioned, if you're going to take the previous year's close offered, you go to the midpoint. There was a couple of traps below the midpoint, but then it gave it up and it dropped some more. And here we are holding 160. And the previous year's low is still 115. So do we still need to go down there and take that out? Do we still need to go down there and grab that? Obviously, we've had a good move over the last week plus. Earnings here was, a day where it gapped down to 160 and then rallied really well to 180. So earnings was a big day there. I would say there's still supply chain issues. There's still so many that want their product, but they can't get it out to them in quantities that they would want, which is a good problem to have, but also a bad problem to have, right? People want your thing so badly, but they can't get your thing in the quantities they want. And there's more need for your thing, not only now, but in the future. I mean, cars need them, phones, and all the various things, right? Everything, which are some of the products that you never needed them for before. So anyways, this is still a very good long-term stock. So I still like Nvidia from a long-term perspective. One of the things I tend to say also, when you have a very good stock like this and it gets cut in half, I mean, this one went from 340 to 160. So it got cut by more than half. Usually at that point right there is an opportunity for major institutions and others to come buy it off that area. And you're seeing that right now. You're seeing that defense between 160 and 170, and you're seeing the bounce. Just to get back to break even on the year, big time percentage gain that would be. So I still think that this has really good long-term potential. Or not potential. I mean, it's going to be still good in the long term. Is it done in the short term? And again, you don't even have to hold it long term to make money in this one. You can just take it from a short term perspective. Look back here when it bounced off these lows at 210. The thing rallied to 290. So that was an 80-point rally. But unfortunately, it then dropped, 100 plus points, 130 points down. Right now, strong double bottom. A recovery of the 180. It looks a lot like the NQ. It looks a lot like the ES and the YM. It had a really strong day today. And again, if we can find an early pullback low tomorrow, we might challenge 200 up above. And if it can overcome 200, I would give this thing to about 226. As a good short-term target. So again, this thing you don't have to have it long-term to make some money here. If this thing pulls back and can hold the 190, 190 could be 225, and that's a good little short-term move. The reason I'm saying 225 again is that's a monthly average, 75% target, which is a high-quality target when you find a strong low, and it is also composite value, composite VWAP. And yearly composite VWAP. So it starts calculating at the beginning of the year, and now 5 months in, this is value. Value is 226. When you get too far away from it, it snaps back. You get too far, it snaps back. You get too far, it snaps back. Well, it's gotten really far, and then it double bottomed. So best case scenario, again, 190 to 226 could be ahead. But even if that happens, it wouldn't surprise me if it sees another pullback, right? This market may not be done dropping just yet, but that's a good rally off the 160. It's been 35 points off those lows, and we still may have another 30 points to go to the upside. And again, as I say, a bear market rally can be super, super bullish. I mean, this one went from 210 to 290. That's an 80-point rally, and it did it in about 2 weeks. So it could certainly do the same thing here. That would be 70 points to get you to about 225, 230. So not bad. I do like this one from a long-term perspective. And again, short-term could be very nice for at least a little bit of a move to about 225. AMD. Let's take a look at AMD here. And we'll talk Amazon and Google as well. Garland and especially the split as well. We'll do that here in a moment. So here's AMD. Again, case in point, you got your lower low failure, and here we look up a few weeks later and we're hitting value. You know, you get too far away from value at times and you see a rejection, you're going to snap back to it. The problem here is that value is dropping. It's a declining value. It started here for the year, dropped, and continues to drop. So when you have a dropping value like that, anytime it hits it, it tends to be an opportunity to sell it. Not necessarily short it, but maybe take profits. You know, you bought undervalued and you return it to value. As a matter of fact, this green line right here is S2. That's the second standard deviation below yearly value. So you had it 2 standard deviations below and it came back. That's pretty solid. It's a good move. AMD is pretty much in the same boat as an Nvidia. You know, a product that people want, can't necessarily get all the quantities for, so you're not going to see a tremendous out of nowhere rally this thing back to here. But we can use market structure to maybe get back to 125 on the high end. You know, you have the 99 level right there. You have this rounded bottom, and then this is what I would call a transition phase of prices below this larger market structure and now back into it. And when you get back into it, there tends to be an opportunity to rally back above to the upper end of this market structure, and then maybe you chop in here. So this is not bad. Again, very similar to, and man, I hope they don't pull the rug tomorrow morning. You say all these good things, and then tomorrow morning NFP comes out and then something bad happens. But you get a big day up like this, what I call a stop run day up, a massive breakout through 3-day range. Ideally, you see any morning weakness defended and you close higher, and then you make your continuation move. So again, using the month's low, the current month's low, we might see a move toward 116s. We may see a move as high as 120, and that would be R1 above. Probably wouldn't go too far beyond that. You know, you take your money and run where you can get it right now. The other caveat is that, you know, when you have a range this big for a day, the next day can tend to be a smaller range day. That would be a digestive day. What you don't want to see is a strong rejection of prices above 110 and then price close below this midpoint. This day, basically. You don't want to see that day where it rejects those prices, it pushes through the mid, and all of a sudden it's outside day down. That's a gotcha day. You know, that's a day where they trap you and reverse you. That's what you don't want to see tomorrow. And again, hopefully that's not the case. I try to, you know, keep it positive and see if we can extend this thing to the upside. But this market has been relentless about pulling the rug out from under you when things get bullish finally. I do think that this 100 level has been very reliable. You see the LVN, you see support, 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 and then when price came below it, a great rounded bottom, the ability to transition. You know, again, most of the time you'll see an attempt to go up here toward the top end of that range, even if once you get there it turns back down, which may be the case. So keeping it short term, if this thing can hold 105s, you could see about a plus 15 to 20 to the upside from a short-term perspective. Okay, let's take a look here. Nifty 50. I'm forgetting the is it NSEI? Here, let's just type Nifty in here. Why am I forgetting the symbol here? It's not. If you give me the symbol there, maybe I'll get it better here. This one is Nifty India Financials ETF. I forgot my symbol for Nifty 50. on Thinkorswim. Oh, is it just Nifty maybe? No. Well, I forgot the symbol, so if you pop the symbol in there for me, maybe I'll get to it here in a moment. My brain is not working right now. They took blood for me this morning, and that's probably the portion where it made me forget. Let's take a look at some of these other ones here as I try to remember that symbol. Amazon, for example, and I know I'm going extra long right now. WTD. Yeah, I'm not seeing that either. I forgot what the symbol is. It'll come to me here. NFTY maybe. Aha! NFTY. There it is. Thank you for that. Okay, we'll do NFTY. Nifty 50 is ETF, or at least the index for India here. Man, India has not seen quite the dramatic decline as some of the broader markets here, especially tech related. But at least from this perspective, that we're seeing here on the chart, it has a very mature rounded top. And earlier we talked about the rounded bottoms and how strong they can be. And oh, thanks Proforma. Yep. This one right here has a very mature rounded top right now, and those tend to see significant continuations to the downside and likely toward... Oh, thank you for that link as well, Vanu. Because you have there's others. I'll have to plot some of those other ones as well. But this one, again, when you have a big rounded top like that, it's an indication of a market that's topping out. Obviously, you have distribution phase that's developing, and then you're starting to see price eat through what I call the rim of the pattern, which is in this case 44s. You can see how it was support, is support, is support, is support, and then it fails. Now it's coming back to hold that level, and if it can climb back above 44 again, there's a little bit of strength that can be seen back towards, say, value. VPOC being, or VWAP being 46s, but it's clear this is mostly in a downtrend here. Again, if there's a major rejection of prices between 44 and 45, we still may have lower prices up ahead, and 38 would be the previous year's low price. And this is kind of what we're seeing in the broader markets, is basically, in the U.S. at least, all the strength from last year is currently being taken away, and you got to walk all of that back down. So at the very least, a rejection of prices above 44s, the next rejection, could lead us down toward 38s. Once you get down there, there may be an opportunity to look for rejection, and then you snap back to value. Value would be 42.40 right now. And so far that level's been holding. At least on this chart, not very mature value, but that's what I'm seeing at the moment with the data I have. So again, 44 is going to be very important here. Rounded top, downward sloping. A rejection here could bring us back into 38. So 38 could still be ahead. And usually when you finally get to that level, kind of like the NQ, for example, when you finally get to the previous low, there could be a push through that low, maybe a trap below it here, say 36, and then 36 you may be able to trap it back and return it higher. So maybe something like this, and you rally back above as it steps back on top of the previous year's low. So again, right now hasn't done super bad in terms of the overall index here, or the ETF for the index, but it's clearly given up that $44 level. And on this next attempt higher, if there's some sort of major rejection, something like this day, or some rejection of prices above there, you also see the previous year's midpoint here. So I mean, again, you go up here, you reject from below, you may be making a move down there toward 38, the previous year's low, and then that might provide a great opportunity. If you're able to pick it up somewhere in here, that could provide a good opportunity to snap it back. Good stuff there. Now let's go over to Amazon here. So Amazon, there, again, we have the 20-for-1 split coming up. It's right here on the 6th. This, the split was announced basically right here. So on that day, and then the next day gaps up, and then it rallies. And there's a tendency on those split days to get in, and you see it rally. Obviously, that rally happened right before one of the most crushing declines that we've seen in the market in a long while, and in this stock specifically. To go from 3,400 to 2,050 is just incredible. To go from 3,800 to 2,050, incredible. I mean, those are significant. That's a significant percentage loss that you wouldn't normally associate with an Amazon, for example. But it happened. And one of the levels that I mentioned to our room that is a must hold, a critical must hold, is 2,050. And it's a major market structure level. If you bring this back, you'll see it here. And this is a big time level here. You can see the 2,050 level right there, the bottom of which is 1,300, and it traded between 2,050 and 1,300. Here's your 1,700 level as well, kind of that, not quite the middle zone, but thereabouts. If this thing would have failed to hold 2,050, and it still could at some point, then you have this D-shaped profile to trade through. First reaching value, and then running your way to the other side of value, and that would be your buy point down the road. It held 2,050, and it did so on a lower low failure and bounced, almost 400 points now. And again, there's a tendency for this thing to rally before a major split, 20-for-1 in this case. So that's huge. That's significant. Once it splits, and I know there's a question on splits, the better the stock, the better the outcome. There tends to be a case where, once you split, it tends to be the high, and then you drop away from that level, and then it takes a long time for you to come back to that split price and then go. In this case, and Amazon is one of the best stocks in the world, one of the best companies in the world, on hard times right now, and it's understandable. You see the 2,800 level was kind of a must-hold zone, and once it wasn't able to hold, I think I said 27 to 2,800 to begin the year. Once that wasn't able to hold, it opened up the downside at 2,050, the next must-hold. So as of right now, you have 2,050 up to 2,700. That's your zone right now. It's this zone right here where, again, you have this narrow portion of the profile. You have this big bulbous D shape, then you have this big bulbous D shape, and then you have this tiny little LVN channel. And again, based off of developing market profile analysis, at some point down the road, you got to go and fill that in. And the only way you can fill it in is to trade through it, then trade through it, then trade through it, then trade through it, and it starts to build it out. That's where we're at right now. So again, the good news is it held 2050 ahead of the split, and it was enough of a rejection point that you likely see a move up toward 2700. We may still see this thing rally to 2700, in which case, once the split happens, it may drop and trade in this zone for a little while. And again, the numbers will change. Since it's 20 for 1, I guess we're going to be dividing that last price by 20. And we'll get the new prices and the new updated chart there. But for the most part, this thin portion of the channel still needs to be filled in, and that's what it's doing now. You had the one time up over here, then you had the one time down, and now you're making your third pass through it, and you can see how it's starting to build out a little bit. So that's a good thing. Again, when you go back to some of these charts from before, like an Apple or a Tesla, the day it splits is usually the high, and then it pulls back. The better the stock, the better it reclaims that high and pushes through. Sometimes a stock may never get back to that point, or especially if it's not the best type of stock. We've seen that as well. So in this case, I think the fact that you will be taking this 20 to 1 and taking the prices from this 2500 all the way down to triple digits, the low triple digits, that's a win. And I think you will see more jump into it, as you will have more market participants that are able to sling that amount. And I think that'll be good longer term. The one level to keep an eye on, 2050. You break that level, and you have to rotate all the way through this lower D-shaped profile as low as 1300. Again, I don't want to say I don't expect that or expect it. It just is what it is. If it breaks, we have 1788 as CVPOC, and then you got to rotate to the other side in order to find rejection. And if you think about rising inflation, rising prices, less discretionary income, most of what Amazon does is sell things, and there's less things for people to buy with their money. They also have Amazon Web Services, which is a huge part in and of itself. Obviously, that one is likely going strong, but at the same time, you can see why we've had some of this discounting of price. But 2050 is going to be a significant level to watch. Looking at Apple, here's Apple real quickly. Back here, there was a splitting of the price. Right there, 4 to 1. So this one was trading, 4 times that price, whatever that was, $700. On that day, it became the high. This was a different market, obviously, than what we're dealing with now. It pulled back, and then it took months and months and months to go back to that split price. Even Apple. But that high became 137.98. That was your split price day. That day occurred in August, and it finally came back to it right at the end of the year. So it took months. 1, 2, 3, 4 months to come all the way back to that level. And that's in a good stock like Apple. And then once that happened, there was a big trap, and then we still stayed below that price for a while. Now, we came right back to that 137.98 today, or not today, this past week, and that was the must-hold point. So when we were in the trading room, we talked Amazon and Apple and mentioned this is a must-hold. That's the top end of that price that we just talked about. That's the split day price, 137.98. And if you fail there, you rotate to the previous year's low of 116.21. It held that level, it's bounced, and now it's trying to recover the 150 level. Again, Apple, after this discount, looks pretty solid. Not ready to call this a bottom, but it held a must-hold point, just like Amazon did. That's solid. But you can see how that split price is still in play and has been resistance and support. This is when it broke through. This is when it held it. It held it again, and it's been in play. So those are a couple of ways that this thing can play off of it. Sometimes it takes a little while to get there. If you look at something like Tesla, here's Tesla. Here's the split. So the split day was here. That was 5-to-1, and that's at 500. This thing was trading 2,500 bucks on that day, and then it split and went to 500. It pulled back, and it got back to that split price in 3 months and exploded through it. And then again, if you bring over 500, it became support as it went. So, you know, the better the stock, the better it'll blow through that price. But even now, off the 1200 high, it nearly came back to that 539 low. 500 is the split price, and we might still be working toward that here ahead. Now, to begin the year, I mentioned Tesla was likely a good buy in the 750 zone. I said 750 could be your double to 1500 down the way. It might take a little while. I said by the end of the year. If it pulls back in Q1, by the end of Q4, maybe we're there. Obviously, this year's turning out much worse than what we originally anticipated. But it's still hanging around that 750 level. It's not bad. We could still see this thing clear out and hit that low. Remember, when we take out the previous year's midpoint and we get this close to that previous low, it's just very odd for us not to get there. And sometimes what they do is try to make it look like that's the low. They get you long, and they pull the rug out, and then they go get it. So we still might get that low up ahead, but still sitting above that 500 split price here in Tesla. Let's take a look at, I have a couple of stocks here that could be headed higher. PG is one of those. Procter & Gamble, consumer staples stock. This one got lit up here over the last 6 or 8 weeks, but what didn't? Most things did. Just couldn't. Look at this. Again, PivotBoss pivots are just money. Previous year's high, previous year's close, and look at the rejections in that zone. Rejections again, and where did it go? This is the previous year's midpoint, precisely to it, and bounced. This time it went down below it. That green signal right there is the third standard deviation below CVWAP. So it's a max reversal buy signal, 3 standard deviations below, and it rallies. And then today, look at that sharp rejection. That is one of the best 60-minute extreme reversals you'll see. It's a great rejection and a higher low of the previous year's midpoint. And so far, that previous year's midpoint has provided some oomph. So I would say that this could be a nice short-term rally opportunity. Again, 1 to 5 days out, maybe a couple of weeks out, or the entire month. But that first pullback tomorrow morning is going to tell us a lot. If it can hold, we could be looking at a bounce back toward 150 to 151. That's from, a midpoint, maybe say 146 to 151 is a +5. And then from there, maybe we work our way back to value, which is 156 right now. Again, not expecting this thing to come all the way back up to break even on the year, but it did it before. It could certainly do it again. This could be a large form trading range. But this is a great rejection. This is how you want to see it. You want to see third standard deviation rejection. You want to see a recovery of the previous year's midpoint and prior pivot low, and then you want to see a strong retest. That looks solid. That looks like a really good short-term opportunity here in PG. Another one here to keep an eye on is AON. Very similar to what we just saw in PG. You see the midpoint of last year holding on 2 different tests, and then look at today's rejection. Again, if you look at the intraday time frame, rejections across the board, very aggressive continuation throughout the day, almost a bullish outside day. It's a great higher low, perhaps even an inverted head and shoulder type of pattern. This one could make a move again to this upper value level and the previous month's high. That would be, say, between 292 and 295, and right now we're trading 278. So again, the play on this one is just we're looking out, say, 1 week out, maybe even 1 day. 1 day to 5 days, maybe 1 to 2 weeks at the most. But early pullback, you defend at 275, and then you watch this thing rally to 295. That'd be a plus 20 over the next 1 to 2 weeks. That could be in play up ahead. Again, keeping it short term because this has been a very bearish market overall. Rallies have been fleeting. They've been short-lived. But the way that we're looking in some of these stocks right now, the aggressive rallies that we saw today, not bad. Not bad at all. There could be about a plus 20 in this one. ISRG, this is Intuitive Surgical. Another one that could be short-term bullish. Look at where this one's at. This one sold off tremendously from the previous year's close and highs. 370 on the high, and it dropped all the way down to 210 as of this past month. That's a massive, massive haircut. A lot of doctors probably not happy. They probably all own this stock. 310, major resistance. The bottom edge here is 260. But look what's happening here. You got yourself a little bit of a box. A box that has developed over the last couple of weeks. If you put a 14-day on it, you can see it's compressed. You can see that there's room to run if this thing were to see expansion. And it's also that box has formed below the previous year's low. Whenever you see a box form below a previous year's low like that, there can tend to be massive expansion up above. So if this thing can get above 230, it wouldn't surprise me if we make a move to 260. And then maybe we trade between 260 and 230 for a little while. So this one above 230 opens up 260, and it could be very nice, especially with the amount of energy we have developed down here. So that could be significant right there. Another one here I wanted to point out is Starbucks. Starbucks, because we have a lower value with a change of bias. So look at this. Obviously it's been crushed. Sold off from the previous year's close of 117, got to a low of 68. That's a massive haircut. We've been downtrending ever since. That's significant. So again, not expecting this to be the low of the year, not expecting this to be a massive bounce back to 95s. This is a short-term swing opportunity. This could even be a one-day rally for those of you that just want to day trade tomorrow if NFP comes out bullish. But you're finishing the day with a bullish outside day. If you get an early pullback, say to 78, 78 could open up 82. 82 could open up 86 over the course of a week. So what we're trying to do is gun for that line right there. That's value. We haven't hit it at all this year. It took it offered after the first 3 days of the year. And then look at this thing drop, 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 drop. Almost got it here. Drop, drop, drop. So maybe we don't get quite that high, but 80, 85, 86 could be in play. From today's low, you can see that 85 to 88 is the high probability target zone. So again, these are short-term swing candidates that could be in play over the next 1 to 5 days, maybe as much as 2 weeks. Chewy is another one. Chewy had earnings here. It made 4 pennies instead of losing 11 as an estimate. It has a lower value relationship with a confirming bias, but look at the gap up today. It was up 24% today. That's a massive turnaround. Additionally, you have this box here, and it's starting to chip away at that box and try to break through the top. Again, if we can get an early pullback tomorrow, 2750 could open up 3250. That's a 5-point move. Maybe not all in one day, but it could be a 1 to 5 day move to that zone, or maybe even the zone into here. If we're just going back to prior support, that would take us, say, to 37. So that could be a plus 10. 27.5 to 37.5. That's a plus 10 over the next 1 to 2 weeks. That could be in play if this change of bias here and this reaction to earnings is true. Now again, that's about as high as I would go. Once you get there, you're reaching a declining VWAP, and that thing might get sold yet again given the overall market. But that's a good short-term 1 to 5 day, maybe 2 week type of move. Another one, I'm going to leave you with some bullish ones here that have been trending higher. We have some great trending moves here in some of these stocks. Suncor Energy, most of them are energy stocks. Look at the trend of this one. This one's been fantastic. From the beginning of the year, every month, stair-stepping higher on a higher value relationship. And here it is again. So if we begin the month with a little bit of weakness, somewhere in this pink zone here, we could find another strong low like this, or this, or something in here, any of these. You pull back, and you're looking to finish the month higher. So again, stair-stepping higher off the pivot range. This one's not ready just yet, but if you pull back, say to 38.50 could provide a buy opportunity to 42.50 or 43, something like that. Another one that looks like this is Valero. Again, another energy stock. Another one that's been very bullish. We had this one as a buy candidate right here. Because of the uptrending nature, because of the pullback, because of that strong rejection low, and this thing exploded to the upside. We now have another higher value relationship. We're on highs, so it's not ready yet. But if we see a little bit of a pullback, a 1 to 3 day pullback, say into about 123 or so, that could provide a move. That could be 15 points higher. 138 could be an easy target from a 123. And again, not quite ready. Something like we mentioned back here, though, if we get ourselves a pullback, and we did, and we find a strong low, as we did, and that strong low is in a good spot, it could lead to a nice burst higher. This one's been trending up, so you want to buy the dips on these pullbacks for these energy stocks. That's VLO. PBF is another one that's looking very similar. We had it as a buy candidate here and here. On those pullbacks, you see a 3 day pullback, another 2 or 3 day pullback, but it's in the direction of the trend. You're seeing a strong low. It's stair-stepping up the pivot range. All those good things. So right now it's on the highs of the year, so it's not ready yet. But if you get yourself a 1 to 3 day pullback, somewhere between 31 and 32 could be a buy, and you could be looking at a 37, 38 target up ahead. So this could be another buy the dip. So keep this one on the buy the dip list. And WMB, another one trending up. So there are a few stocks, right, that are trending up, looking very good. This is another one of those Williams companies here. If we see a pullback, say to 30, 36 or so, 36 could open up a move toward 40 plus. So again, if there's a 1, 2, 3, 4 day pullback, something like this, something like this, something like that, watch for the rejection and look to turn this thing back up, as it is in a very clear uptrend. The last one I'll cover is PPC. Pro forma asking about this one. And this one is trending up as well. Pilgrim's Pride. Man, very strong blowout low down here, and it's been a missile to the upside ever since. Again, another one that's had multiple higher value relationships here, and it kind of looks like some of the ones we just covered. On highs, You ideally want to wait for a pullback into the Pima trigger zone and the higher value relationship of the pivot range. You know, you get yourself a good 1 or 2 or 3 day pullback, which has been hard to come by in this one. I mean, it's been so solid. But if you do, if you get, you know, say to 32, 32 could open up a move for higher lows and goes up ahead. So this one's right in line with the ones we just mentioned as those that are trending higher. Oftentimes it's better to buy the dips in something that has a very good, strong uptrend than it is trying to pick the bottom of things that are just falling out. So to leave you with those, I think is a good way to go here. Again, we've made it about 2 hours today. Thank you very much for joining me for this month's monthly market outlook, June 22 in the books here. Again, I always appreciate all of you staying with me for one of these sessions. Always my pleasure. I will get this recording out to you and available to you as soon as possible. Everyone have a fantastic evening. Check out my book, Secrets of a Pivot Boss, if you haven't already, and we'll be back at it in our trading room tomorrow morning. TGIF. I definitely need it already, even on a shortened week. All right, everyone, have a fantastic rest of your night, and I'll see you soon. Take care.